Investors are paying more attention to ESG, but 92% of them worry that it could hurt business performance in the short term. Do you know what this means for businesses? We have here Benjamin Saw from ESGpedia, Professor Lawrence Law from the NUS Business School, and Tianhao Yao from SMU. Now, going straight to our topic, why do investors see ESG initiatives as a short-term risk?
Yes, I think for ESG initiatives, the difficulty is always starting, in other words, jumping on to this initiative. And I think sometimes there's inertia or even resistance. And I would say this can be attributed to various factors on the ESG initiative. For example, on the financial front, there may be certain doubts about the cost as well as the value. And actually, secondly, and quite importantly, is the business aspects, which includes, say, the integration of the ESG into the business, as well as certain, I would say, possible disruption. And of course, thirdly, from the marketing viewpoint, customers may actually have different preferences. So you might actually lose out your market share. And last, and I think very, very importantly, is the regulatory uncertainty. Regulation is still evolving, and sometimes they may change. So in other words, this is actually something that could be a short-term risk as well.
So this is mainly because the stock market or asset prices in general are actually forward-looking, which means that the price today will reflect events that potentially happen in, let's say, 5 to 10 years. As a result, even you believe that ESG initiatives matter more for the operations of firms in the long run, these long-run initiatives will be incorporated into asset prices today. In particular, if there is any update on the belief of these ESG matters, it will drive the asset price fluctuation and affect investor wealth, even in the short term. For example, imagine tomorrow there's a clean technology breakthrough which will drive down the demand of fossil fuels. So even though these technology will only be industrialized in several years, this will already cause repricing of fossil fuel assets in the short run. And therefore, as a short-term investor, say you only plan to hold the assets for several months, these ESG matters are still a significant risk to you.
Investors sometimes see ESG initiatives as a short-term risk because they have to spend some money initially to be able to change out some of the equipment, for example, to adopt sustainable solutions. For example, if I was to adopt some equipment or change out my fuel type for renewable fuels, for example, there would usually be a short-term cost. And this is usually due to a lack of awareness about how the benefits that this change might bring to us. So this results in the lack of understanding of how the long-term benefit could actually overcome the short-term cost. And that leads to investor risk apprehension.
But out of all the industries, which one faces the greatest short-term ESG performance challenges?
I would say almost all industries across the board will face ESG performance, particularly in the short term. And I think the more fundamental would be those that is directly related to ESG. For example, and in particular, energy industries, the oil and gas, and I think these are some of the industries in particular that would face the challenge of ESG. And of course, you look down the high impact industries will also include transportation, especially aviation, construction, including real estate development. And I'll say there are also a whole host of other industries that are directly related to ESG, for example, travel, for example, manufacturing and industrial that includes chemical. And of course, don't forget finance. I mean, fundamentally, it's the derived industry that depend very much on the fundamental industrial evolution.
So there are many of them actually. So when mentioning this, people tend to think about energy sector, industries, or manufacturing. But actually, one of the industries that many investors pay less attention to is actually consumer-oriented industries, which are also at the forefront of the ESG trend. This is mainly because consumers, after receiving all the sustainability information over years, start to care a lot about sustainability when they consume. So there are systematic academic evidence and tons of anecdotes that, for example, when a consumer-oriented company experiences some negative ESG scandals, they will lose their customers. So their stores will be visited less by visitors, and they will have lower sales, lower earnings, drop stock value, even after a few years after the scandals.
I would say that most traditional industries that require a lot of infrastructure will face this challenge. For example, logistics vehicle would be able to require the charging infrastructure if they were to move from a fuel power fleet to a electric fleet. Okay, similarly, if I was in the construction sector and if I want to switch out this equipment from a traditional construction equipment to electrified construction equipment, I would also need this charging infrastructure. So sometimes it's not about asking them to purchase these vehicles or purchase this equipment, but it's also providing them the right infrastructure to allow them to be able to charge this equipment easily and efficiently.
So how can companies improve ESG transparency to ease investor concerns?
I think there are many things companies can do. I think first and foremost, very importantly, would be disclosures and reporting. It's very critical that companies use things that are acceptable globally, so they can use standards that comes with, say, metrics and target. And I think if you do disclosure and reporting, secondly, it's very important that they are verified. In other words, you do auditing, or sometimes it's called assurance. You can do it externally, which is independent, or even internally. And very importantly, I think companies must, of course, do their stakeholder engagement. They must continue to be relentless in their communications effort to all those affected by ESG, inside as well as outside the company.
So there are two things to me. The first is the improve the disclosure of companies. So companies need to disclose more transparent, more precise, and more mature information to the investors so that the investors can better assess the risk of the companies. A second is the distance between company disclosures and the information investors receive. So we know that a lot of investors do not have the capacity to go through all the detailed disclosures of companies. As a result, they will rely on the summarized version of this information, for example, ESG ratings or ESG scores. And we know that there are a lot of noise today between companies' disclosures to summarize the ESG ratings. And there are also regulations coming up to regulate the ESG rating market. So if we can improve the distance between the company's disclosure and the ESG ratings, investors will be better informed.
I think the greater enabler here is if we could embrace technology. In my work, we actually do try to provide a lot of digital solutions to help companies quantify the proceeds or the benefits or the efficiency gain savings by having these solutions deployed, and therefore allowing for greater impact and of course cost savings. For example, if I were to use electricity instead of fuel, okay, to be able to go and charge my vehicles, I could be possibly using solar, which is an initial investment, but I could also generate a lot of savings every month for the next 10 years by using solar energy instead of fuel energy. So that's where investors need to see that there is a very great trade-off of benefits to be able to get these benefits, okay, by just a minimal one-time cost. And that actually makes a lot of business sense. Just like any investment, okay, we could see that there's a greater ROI if we are able to show this value and quantify this value using certain solutions out there.
Thank you so much for your time today, Benjamin, Professor Law, and Tian Hao.
Thank you.
Thank you, everybody.
Thank you.
Once again, those were Benjamin So, founder and managing director of ESGpedia, Professor Lawrence Law, director of the Center for Governance and Sustainability at the National University of Singapore Business School, and Tianhao Yao, assistant professor of finance at Singapore Management University. For more news, visit esgbusiness.com.